Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny but cold Redmond, Washington. Thanks for joining me every weekday after the close as we break down the activity in the markets and try to make sense of things after spending last week in Mumbai, India, where it was very warm and quite comfortable. I'm back to the Seattle area where we have temperatures in the low 40s. Nice, consistent misty rain happening at times. Back to reality. What is not chilled out is the market. Thursday's move to the upside, pretty impressive. Friday, more of the same. And that's a big question mark after you have a big run, is if you get follow through. The Dow spent most of the day below zero, finished up just narrowly positive, but the NASDAQ was up almost 2% today, signifying or certainly indicating continued optimism. It was not just a one-day thing. Certainly needs to be a continuation of the trend that's happened up till now. We have some great guests coming through the Final Bar, and excited next week to get back to some really good guest discussions. On Tuesday, the 15th, we have Larry Tentarelli of Blue Chip Daily. On Wednesday, Ryan Dietrich from the Carson Group. And then on Thursday, the 17th, Julius DeKempener of RRG Research. Also, on Friday, November 18th, we will be releasing our latest episode of The Pitch. You can go to stockcharts.com/The Pitch for information on that fantastic regular broadcast. I will be interviewing three panelists: Julius DeKempener, John Kosar of Asbury Research, and Jeff Huge of JWH Investments. They'll each bring three charts to share with you with their arguments for each, and we'll discuss them as a team. It's a lot of fun. Again, go to stockcharts.com/The Pitch for more information on that regular show. Let's continue on our show today with our next segment, Wrap the Week. What we like to do is focus on how the markets have evolved and really think about the big picture here. So what we'll do is three parts here. We will start looking at the markets and how they performed today. We'll talk briefly about that. We'll then look at the Wrap the Week chart, which is looking at the last 5 trading days, really think about what's happened and put this week into proper context. Then we will get as far as we can through the Mindful Investor live chart list. This is a list of charts that I keep updated on the StockCharts platform and can be really, really valuable to help make sense of things. Before we get there, by the way, though, I do want to start with a poll. We asked you recently in a poll on our social media accounts and also on our YouTube channel and elsewhere on our live stream page. We asked you which of the generals performs best over the next 3 months: GE, General Electric; GM, General Motors; General Mills, GIS; or Dollar General, DG. And 53% of you said Dollar General. So let's start there. The dollar stores overall, again, sort of choppy, right? And while they've held up very, very well and have outperformed on a relative basis pretty handily in 2022, the uptrend that you saw in the first into the second quarter sort of stalled out. What's frustrating about a chart of DG is that it's hit resistance around 260 a number of times, just recently pulling back off of that resistance level as well. So on an absolute basis, not a fantastic chart. Let's compare that to some other ones. GE looks like this, breaking above its August high most recently. GM looks like this, very close to resistance at 42, but not quite breaking out yet. And then General Mills looks like this one, GIS, pulling back with other staple stocks here this week, but probably the strongest trend, undeniably the strongest trend in 2022. Which would I pick for the next 3 months? Boy, unpopular. I probably pick General Mills. And the reason is because I find the defensive nature of this, but the long-term uptrend very compelling, right? This is sort of that fat pitch chart where you have a long-term uptrend, a short-term pullback. So I can guess that 32% of you probably cautious on the market, because if you're picking General Mills, you're probably not thinking that risk-on names like a GM or General Electric are going to continue to push to the upside. I'd probably go back and forth between General Electric and General Mills. I'd probably pick one of those. The problem I have with Dollar General is it's hit resistance and just has stayed there, while these other ones are actually showing signs of improvement. So I probably want to be in one of those names. Thanks so much for answering that poll, by the way. Make sure you subscribe to our YouTube channel. Give us a follow on Twitter so you don't miss the next one. Touching in on what happened today, it's worth noting the S&P bounced right up to 4,000, almost to the penny before pulling back, closing the day just above 39.90. The NASDAQ composite up almost 2% today. Again, nice follow through from Thursday's rally where the NASDAQ was up 5, 6, 7%, depending on what part of the market you're looking at. Mids and smalls both up about 0.5%, and the VIX continuing to pull back from its recent high in the low mid 30s. We're now down to the low 20s, and that sort of draining of volatility is one of the things that has lined up pretty well with the overall market going higher. Bond markets closed today for Veterans Day, and thank you so much, veterans, for your service and your commitment to your country. We appreciate it so much. So bond markets flat today. If they were open, I would most likely expect yields went down today if it had been trading, but certainly did not. And the reason is because it's mapped pretty well to the dollar index. The dollar down today. The UUP was down about 1.4%, continuing a significant drop from yesterday. And I would argue, if you're bullish right now, you better be super bearish the dollar, because the one of the main reasons why the markets have been so challenged in 2022, particularly risk assets, has been the strength in the dollar. The dollar strength alleviated is what gives space for risk assets to start to emerge. And so if you're bulled up and you think S&P 4300 is an obvious next step, which I've heard some of you on social media making that argument, I get it. You better be hoping the dollar continues to go down. It certainly may, right? I mean, the trend in the dollar has been very consistent until the last 6 weeks, and you saw October, the dollar put in a lower high, and from there, it's now put a new low. It's gone below its 50-day moving average, which is sort of a new development. So certainly a place to watch. Given the weaker dollar, though, and along with the weaker dollar, you actually had stronger gold. So gold price is up about 0.2%. The broader commodity index up almost 2%. The energy sector was the best performer of all of them today. Cryptocurrencies had a nice rebound yesterday, but while stocks continued to push higher and built on yesterday's gains, cryptocurrencies gave a lot of it back. So Bitcoin actually down 5%, just above 16,600. Ether just below 1250, and that's down 3.5% yesterday. You can see the 10 big coins that we track on StockCharts all in the red today. Not nearly as deep in the red as they were earlier in this week when you had the FTX debacle and you had them down 10-20% at a clip. This is more a measured loss, but still certainly worth noting that yesterday's gain, where it was like an everything rally, today a little bit more differentiation, and you can see that cryptocurrency is not participating in the upside for other risk assets. Just quickly looking at sectors, energy, the number one sector. So I was asking a couple interviews today. I was talking with Reuters, investing.com, and I was asked about the energy sector, and basically, right, because the markets are obviously in this huge bull market, all of a sudden, don't you want to own growth stocks? And my answer was, I'd want to own energy. If I had a choice of anything, I'd probably want to own the energy sector, because I think that's where strength has been. And I think with a rate environment, interest rate environment that remains elevated, even though we've pulled back a bit, I don't think we've seen the high in the 10-year yet. And if you agree with that statement, you probably want to be looking for opportunities in the value-oriented parts of the market, things like materials and energy playing on stronger commodity prices. And again, that's based on the dollar certainly going weaker as well. That would fuel that sort of development at the same time. Briefly, let's look at the wrap the week chart. So this is a chart looking at 5 major asset classes. We start the clock last Friday on November 4th, and we're looking at the 5 trading days since then. How have these major asset classes done? Now, it's a bit of an outlier to the downside this week because Bitcoin was down 21% so far this week, and that's with Thursday's gain. We gave about half of that back today. So Bitcoin currently down 21%. That's the worst performer for the week. Here's the S&P 500 with a strong week, and certainly one of the stronger weeks in 2022, if not since the 2020 low. The S&P 500 up 5.9%. The NASDAQ 100 up here is up 8.9%. I'm going to take, hold on a second, I'm just going to take Bitcoin out of the picture so we can zoom in a little bit on these other asset classes. Here we go. So there's the S&P up 5.9%. There's the NASDAQ 100, the Q's up 8.8%. What a strong week for technology and that technology-heavy index. Everything else underperformed the S&P this week. From the top, we have emerging markets up 5.4%. Gold up 5.2%. So even in a week when stocks are up pretty big, gold had a pretty decent week as well. And it shows you how it's, the dollar strength has killed everything. Dollar weakness gives room for all sorts of things to improve. In purple, we have the Russell 2000 up 4.6%. In red, bond prices, the TLT up 3.9%. Again, bond markets were closed today. It's just a little bit of a pullback in the TLT, but Monday we'll get a little more clarity in rates and bonds. Crude oil narrowly escaped the bottom of the list there, with the USO finishing the week down 3.2%. And in green, the US dollar ETF down just about 4%. We will finish off this part of the show looking at the Mindful Investor Live chart list. As a reminder, this is a list of charts that I keep updated on the StockCharts platform. You can go to my blog, go to the articles tab at the top of the page, go to my blog called The Mindful Investor, and you can see at the top there's a gray button that says Live Chart List. That'll get you to this list of charts, and I'd encourage you to explore them on your own. We rarely get that far in this list. This is a list that I spent time every week with my market misbehavior premium members. We go a lot more depth into these charts and talk about some of the key takeaways. We start with the market trend model. I update this model every Friday, and it's based on weekly data. It's based on a series of weekly exponential moving averages that are designed to track the trends on 3 time frames. Very loosely speaking, the short-term time frame for me is a couple days to a couple weeks. The medium term is a 1 to 3 months, and the long term is 1 year plus. And that's generally how I think of the 3 timeframes that I'm interested in. Now, if you're an ultra long-term investor looking in a retirement account, you probably have a very long-term time frame, sort of longer than that. If you're a day trader or a swing trader, you may have a short-term, a very short-term time frame that's even more granular than what I'm looking at. But for me, being sort of a medium-term investor, in general, looking 1 to 3 months down the road, this is about the right time frame. So I'm looking at my main time frame, which is the histogram in the middle, just narrowly remaining bearish, but it was really close. I was wondering going into the weekend if it would be enough strength to turn my medium-term model bullish for the first time since August. Didn't quite happen. It remained actually bearish. Short-term model certainly strong and getting stronger this week. The long-term model remaining very negative. And that is pretty much exactly how I would read this market. Short-term undeniably strong out of the October lows. The long-term undeniably weak with the clear downtrend of lower highs and lower lows in 2022. And the medium term kind of mixed, right? It's sort of not enough to convince me that the medium term trend is positive, but it's enough to know that we're maybe really close to that. I was engaged in social media earlier this week. How can you call this a bear market rally because of X, Y, Z, ABC, and et cetera, et cetera. They actually didn't give a lot of details. It was just more pointing out, how can you call this a bear market rally? Because obviously things are so bullish. And this chart is probably one of the ways I would do it. When I think about multiple timeframes at the beginning of as an inflection point, maybe turning, I'm not trying to pick the bottom as it's happening. I would I'm much more comfortable waiting for confirmation that the trend is positive. I just haven't seen enough to convince me that this just isn't exactly like we saw in July and August, exactly like we saw in March and April, which were bear market rallies within a long-term downtrend. Now, what may be different this time is a number of things, particularly the seasonality, right? The seasonality is actually very strong, and it's been weaker earlier in the year, and we've seen some of those rallies. So the fact that the seasonal tendencies are strong, the market is strong, certainly individual stocks are strong. We have pointed out many times on this show, even recently. The daily chart of the S&P looks like this. The RSI finishing the week just above 60. I think that might be a really important data point to watch. When the RSI is below 60, that tends to indicate more of a bear market phase. When the RSI gets above 60, that's more of a bull market phase. And so I think for me, that's one important data point to pay attention to. Previous rallies stalled out at the 200-day moving average and or at the previous swing highs. And we're getting closer to those levels, right? 4,000 is a 61.8% retracement all the way back up from August high to October's low. That's the lower end of the shaded area. The upper end of this shaded area is just trying to capture the 200-day moving average, ending the week just above 40.80. A trend line using the highs in 2022 gives you an upside target around 41.30. So we're entering sort of a confluence of resistance levels, which means for me, between 4,000 and 41.30, that would be a pretty reasonable place for a normal bear market rally to exhaust and for the next leg lower to start. If we would break above there, 43.25 would be my next upside target. That would be a retracement back to the peak in August and would give a similar look to what we saw in March of this year. And then again, if you break above that, then I don't know how you would remain bearish at that point. I certainly wouldn't. But again, at this point, I still think you're in that middle ground where you can make an argument for being bullish, but if you're ignoring some of the long-term trends that still haven't changed, I would argue their trajectory, right? Now, the higher low around 3,700 is an important thing to note as well, and that happened about a week ago. If we would get some pullback into next week, which is certainly possible, 3,700 are really obvious support level to pay attention to, and I would encourage you to pay attention to key levels at all times. That's all the time we have for our Wrap the Week segment. Let's take a quick break. We'll be back powering up your use of the StockCharts platform. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're so excited to have you back on the Final Bar. Great to be back doing the show. We're going to be going back live this coming Monday at 4 p.m. Eastern, so catch us on our live stream page at StockCharts TV. As always, we'll be on our on-demand platforms soon afterwards. A couple quick announcements before we continue on today's show. First off, we welcome your questions. We're going to do a mailbag segment in a few moments, and we would love to feature one of your questions in our next mailbag, which will be Tuesday of next week. Our email is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday's show of next week. Also, go to StockChartsTV.com. That is our on-demand platform. Such fantastic content. I know Larry Williams is recording a market outlook that he will be posting very soon. I think as soon as Monday. Now, we have a lot of great interviews and guest commentators coming through the channel. They are all available for free at StockChartsTV.com, or on your mobile device, just search for StockCharts TV on demand. Our next segment is Power Up. Let's upgrade your use of the StockCharts platform. And because we are now in the seasonally strongest part of the year, I am compelled to show you the seasonality features on StockCharts.com. I was asked earlier today in an interview about seasonality, and the chart I pointed them to was this particular chart. At the top of our screen, right at the top of the traditional StockCharts window, it usually defaults to Sharp Chart, which is our main charting engine. You have StockCharts ACP, which is a dynamic charting engine, which you have available as a StockCharts member as well. Highly recommend, because it's a fantastic toolkit that we will hope to be using on StockCharts TV way more often going forward. We're kind of working through that at the moment. But also, if you click on where it says Sharp Chart, you can see the other charting styles that you have available to you. And what I would want you to do is go to seasonality, then type in any symbol. What that'll do is show you for the last 5 years to start. Here's what it's basically doing. The little numbers above the histogram and the histogram themselves are indicating what percent of the time, going back through each of these calendar months over the last 5 years, or however many years you select here, what percent of the time did the S&P or whatever symbol you brought up, what percent of the time did it close higher than the open for that month? So 75, which is the number for December for the last 5 years, says for the last 5 years, 75% of the time, the market has closed higher than the open. And obviously, that's not including the current year, 2022, we haven't happened. So it's basically looking at the previous 4 years. 3 out of the 4 times we closed higher. You can bring it up to 20 years of data, and I usually like to go as far as I can, because now you start to see a longer term trend, and you're going back to 2003. So you have some bull market phases, some bear market phases, not a ton of bear market phases, let's be clear, but you do have a little bit of a variation there. Here you can see, looking at the last 20 years, again, going back to the 2003 market low, sort of that March 03 low after the October 02 low, you can see that 80% of the time, November has been a positive month. 74% of the time, December has been a positive month. Those are two of the strongest months of the calendar year going back for the last 20 years. These little numbers at the bottom of the histogram tell you the average return. So it's basically the mean return for the last 20 years. On average, November has been up 1.9%. On average, December has been up 1.4%. If you look to the left, you can find a couple months are a little bit better on average, but as a whole, this group, October, November, December, the strongest quarter for sure out of all of them going back. So when we talk about seasonal strength, we're coming out of September, which is one of the weaker months for stocks. And you can see October sort of middle of the road, and then November, December tend to be pretty strong. So when I'm asked about market outlook between now and year end, any sort of bearish evidence that I'm seeing, I think you have to remember that that is within the context of seasonal tendencies, and the seasonal tendencies tend to be very strong. Now, what you have to remember is, even with this environment, 20% of the time, November has been a down month, and almost 1 in 4, 25% of the time, December's been a down month. So down months can't happen, right? They don't necessarily have to be up. But if that happens, that would be very unusual based on the seasonality. I think it's worth paying attention to those seasonal trends. What would be interesting is if we follow the classic seasonal playbook, have strength in November and December, and then a weak January, because January, and it's not even close, tends to be the weakest month for the S&P 500 going back for the last 20 years. You can explore the seasonality chart with a lot of different symbols, a lot of different ETFs, and I would encourage you to do so by exploring the seasonal charts on StockCharts. Let's continue on our show today with the Final Bar mailbag. As a reminder, the mailbag is always open. The Final Bar at StockCharts.com is our email. Here's question number 1. Dave, can you tell me, how did you create the S&P 500 intermarket graph on your October 20th Final Bar show? Also, can you tell me which symbols use the left scale and which symbols use the right scale? This is the chart you were referring to. This is the one I showed. I think it was on that particular day. I actually had to look back at the show to see which one you were referring to. But this is the one. This is actually using our regular charting engine, and it's basically it's a sort of a spaghetti chart is what we usually call this. anecdotally. And what that is basically it's just a bunch of lines on there. And what I found with this is it can be very busy. And so what helps is if you boldface some of the lines, right? So you can see that some of these I've made more dotted, lighter. Some of them I made heavier because in this particular example, I was trying to highlight a specific relationship between stocks and bonds. So in bonds, we are the thick pink line, stocks are the thick black line. And I wanted to sort of focus on that relationship between the two. Here's how I did it. You make a sharp chart using the SPY or whatever you want to start with. And then below, you use the indicator called price, and you just add the tickers. And again, the good thing about ETFs is you have ETFs that track pretty much everything by now. So you can use ETFs as an easy, pretty trackable way of quantifying the performance of those different asset classes. The key here to this type of chart is to do position and switch it to behind price, which means they stack them all on top of each other, makes that spaghetti chart kind of look. This is where you set the color and the style to make them look how you want them to. And then here's the key. The scaling is actually done so that the first ticker, the SPY, is using the right scale. The second ticker, the DBC, is using the left scale. The other ones actually don't have a scale indicated. You can see the current level because it's highlighted there on the right. And I always keep that turned on. It's called Y-axis labels. I would encourage you to do that. It's a great way of just recognizing the current level on anything. But this is meant less to measure actual price levels and more to look at the trends. And that's why this particular chart, what I call a spaghetti chart, where you're just putting them on a pile behind the price, it's not as much on the scaling and the volatility is not normalized. It's more just to capture the direction. So a lot of times with chart design like this, we spend a lot of time at Fidelity in the chart room debating these sorts of things. And it was basically, what question are you trying to answer? And then make sure the chart helps you get to that question more easily, or more effectively. Thanks for that question, by the way. Next question, how did the Bullish Percent Index look back in 2008 to 2009? This is a question that came up after the show yesterday, and I featured the Bullish Percent Index, pointed out how it had broken above 70, which is true, remains above 70 today on today's sort of continued rally. This is what the chart looks like back in 2007 through 2009. And again, one of the great benefits of the StockCharts platform is we have a pretty deep historical database. So when you're looking at a particular signal, it's always helpful to go way back in history. And I guess 20 some years isn't way back, but, 12, 13 years isn't way back, but certainly is going back to a previous bear market cycle and just trying to see how this indicator evolved during that period. What's interesting is through almost the entirety of 2008, actually literally through the entirety of 2008, we never had a Bullish Percent Index above 90, excuse me. That's the red line here. Excuse me, Lord. Above 70. Come on, Keller, read the chart. Above 70, right? So the red line is as a Bullish Percent Index above 70. Getting above 70 in 2022 has been the mark of a bear market rally, and coming out of that 70 level, like we saw here in January of 09, is sort of what we've seen in 2020 quite a bit. It tells you that bear market rally is exhausted. We've rolled over. You didn't have those signals during the 2008 sell-off. And I think part of it is just during the financial crisis, kind of everything was going down. One of the big differences we see now is there are a lot of things that are actually still going up. So the Bullish Percent Index has routinely gotten above 70 because things like energy have bucked the trend and have continued to be strong even in the face of weak benchmarks. So sort of a different look. And I would say that one of the great notable indications in 2009 was you started to get a Bullish Percent Index above 70. And when it finally broke above there and remained high, that told you that 2009's bottom was pretty secure. And then we're in much more of a longer bull market phase out of those lows. Thanks so much for that question. Probably the final question, Dave. A year ago, Tesla skyrocketed to $400 a share. And yesterday was the year low of $177. Today, it rallied along with the tech sector, and I think you sent this question out yesterday. Do you think the correction is over, and is it time to buy again? So as always, I can't make any sort of formal recommendation, so full disclaimer, that's not the goal of the show, and I would encourage you to do your own work and consult a financial professional, of course, before you make any sort of decision. But observations on this chart. So there are two general ways you can do technical analysis, and that's not true. I'm oversimplifying, but just for sake of simplicity, right? Think of it as value versus growth, right? There is an argument to be made for buying sort of the value discipline, buy when things are beaten down and betting that there is going to be mean reversion back to the upside. Approach number two is buy when there's strength, right? So buy more in mid-2021 when we're breaking to new highs, with the idea as strength begets further strength, and you can buy strong and sell when it gets much higher, right? Buy high and sell higher as opposed to buy low and sell high. So if you're more of the value-oriented investor, I could totally get the argument for buying Tesla in this sort of range because you're buying as it comes out of those oversold regions. And if you're looking at a similar development like you saw in March of 21 or May of 21, could get you at a really good point. That is not the way I tend to invest. I'm more of a growth investor. So I wait to see when the momentum has turned, which means I would be looking at something like the MACD or the PPO, and looking for when those indicators would give a sign that the signal is turning, give a sign that there's starting to be enough of a rally that it signifies buyers are coming in. That was a great signal in late May, right? We became oversold. You saw a PPO signal soon afterwards, which indicated a bottom. You actually did have a brief signal toward the end of October, but we're back to a negative trend. So I'd want to see that turn more positive. And if it does, that could be a bullish divergence with lower prices and higher momentum. I personally haven't seen enough to suggest that this is an optimistic chart, particularly since so many other charts look so much better developed in a bullish phase. That's it for the questions today. Thanks so much for sending questions into our mailbag. We need to wrap the show. The 3 and 3, 3 charts in 3 minutes. And here we go. Chart number 1 is the dollar index, $USD. The dollar was down big on Thursday as risk assets rose, and it was down again on Friday, pushing the RSI below 30 for the first time since January 02. And remember that even in that case, it was a brief move below the 40 level. Never got much below there. So if we have a similar pattern to what we saw in January, that could be the end of the pullback in the dollar before a resumption of the uptrend. However, what's much more likely of a scenario is we get further downside in the dollar. I could see downside to 105, which would get to the first Fibonacci level and also put us back to the August lows. If that happens, that would also take us to the 200-day moving average. What would that mean for risk assets? What would that mean for growth stocks like the NASDAQ? What would that mean for gold and other things that have been struggling in a strong dollar environment? That is an open question going into next week. Chart number 2, Norwegian Cruise Lines. One of the things I've been very clear on is despite the challenges for our broad benchmarks, many individual names have been constructive and in ways we've discussed deeply on the show in 2022. Energy, obviously the perfect example of that in the first half of the year. But in recent weeks and months, you've seen emergence of a lot of strength in a lot of different sectors, financials and industrials and materials and consumer discretionary. Cruise lines refusing to go away. Breaking above the September high for NCLH was important. Remaining above there, I think, is what's so vital. We've had a couple choppy days, but we've held that line. We also broke above the 200-day moving average, and just this week got above a trend line from the June high of last year to the September high of last year, continuing to where we're at. Breaking above that trend line is yet another piece of evidence suggesting cruise lines going higher. I'll tell you what did not do well today is WRB, which is an insurance name. Some of the insurance stocks have looked fantastic with strong relative strength. This is a great reminder to always have a good stop loss in place. Charts like WRB that I would argue through earlier this week looked pretty constructive coming off of new 52-week highs. It's pulled back. I don't know if it's pulled back enough to trigger a stop, but I would tell you it's important to pay attention to what levels should suggest that you get out. Folks, that's a wrap for this show. Have a fantastic weekend. We'll see you next week. Bye now.